Preparing for a finance and actuarial at New York Life interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work in finance or actuarial at New York Life? I am attracted to New York Life because its mission connects technical work with long-term financial security. I would enjoy analyzing risk, profitability, and capital while remembering that decisions ultimately affect policyholders and their families. The company's mutual structure also appeals to me because it supports a long-term perspective rather than short-term shareholder pressure. I see the role as a chance to apply quantitative skills, learn insurance deeply, and contribute to disciplined, purpose-driven decision-making. While answering, connect your interest in finance or actuarial work to long-term protection, analytical problem-solving, New York Life's mutual structure, policyholder focus, and the opportunity to support sound decisions across insurance operations. Question 2. What is the difference between life insurance and annuity products? Life insurance primarily pays a benefit when the insured dies, so its central risk is mortality. Annuities generally provide income during a person's lifetime, making longevity and investment risks more important. Life policies collect premiums and pay future death benefits, while annuities may receive deposits and distribute guaranteed or variable income. Those differences affect pricing, reserves, capital, investment strategy, and customer suitability. Understanding the product's cash flow pattern is essential before assessing profitability or risk. Make sure to cover the timing and direction of cash flows, mortality and longevity risks, protection versus accumulation objectives, premium structures, guarantees, and why each product creates different reserving and asset-liability management requirements. Question 3. How would you explain the role of an actuary in an insurance company? An actuary translates uncertain future events into financial decisions. I would expect the role to include pricing products, estimating reserves, forecasting earnings, analyzing experience, supporting capital management, and explaining assumptions to non-technical stakeholders. Actuaries also challenge models and monitor whether actual results match expectations. In practice, the work is highly collaborative. Finance, investments, underwriting, risk, and product teams all depend on actuarial analysis to understand profitability and financial resilience. In your answer, talk about pricing, reserving, forecasting, experience studies, capital, risk management, model governance, communication with finance and business teams, and the actuary's responsibility to balance technical analysis with customer and regulatory considerations. Question 4. What are insurance reserves, and why are they important? Insurance reserves represent the amount an insurer expects to need for future policyholder obligations and related expenses. They are important because premiums are collected today while benefits may be paid decades later. I would calculate or review reserves using projected cash flows, discounting where appropriate, mortality, lapse, expense, and morbidity assumptions. Adequate reserves protect policyholders, support regulatory compliance, and provide credible financial reporting. If reserves are understated, reported earnings and capital can look artificially strong. Be sure to mention reserves as estimates of future obligations, policy benefits and expenses, assumptions, present value concepts, conservatism, adequacy testing, statutory requirements, and the consequences of underestimating liabilities. Question 5. What is asset-liability management in a life insurer? Asset-liability management coordinates investments with the timing, amount, and sensitivity of policyholder cash flows. In a life insurer, I would examine duration, convexity, liquidity, reinvestment needs, guarantees, and interest rate scenarios. For example, assets should generate dependable cash flows when claims, surrenders, or annuity payments become due. Effective ALM does not eliminate risk, but it controls mismatches and helps protect surplus, earnings, and the company's ability to meet long-term promises. Focus on matching asset cash flows with liability duration and guarantees, interest rate risk, reinvestment risk, liquidity, credit risk, scenario analysis, and how supports solvency, earnings stability, and policyholder obligations. Question 6. How do rising interest rates affect a life insurance company? Rising rates have both positive and negative effects. Existing bond prices usually decline, creating unrealized losses and potentially reducing capital, while new investments can earn higher yields over time. Liability values may also fall, depending on product guarantees and valuation rules. Higher rates can change surrender behavior and policyholder demand. I would therefore analyze asset and liability duration, accounting treatment, liquidity, and reinvestment effects before concluding whether the overall impact is favorable. Discuss immediate bond valuation losses, improved reinvestment yields, liability sensitivity, surrender behavior, spread income, capital impacts, and the importance of analyzing duration mismatch rather than assuming higher rates are automatically beneficial. Question 7. What is the difference between statutory accounting and generally accepted accounting principles reporting for insurers? Statutory accounting is designed primarily to protect policyholders and assess solvency, so it is generally more conservative and focused on available capital. Generally accepted accounting principles reporting is intended to present financial performance and position to investors and other stakeholders. The two bases can differ in asset admission, reserve calculations, acquisition costs, and earnings recognition. I would never compare results without understanding the accounting basis, and I would reconcile differences carefully when explaining capital, profitability, or trends. In your answer, distinguish regulatory solvency reporting from investor-oriented performance reporting. Discuss conservatism, admitted assets, reserves, capital, earnings patterns, and why finance professionals must reconcile different bases accurately. Question 8. How would you assess the profitability of a life insurance product? I would project premiums, benefits, expenses, commissions, taxes, capital requirements, and investment income over the product's life. Then I would assess measures such as present value of profits, internal rate of return, or value of new business, depending on the framework. Sensitivities would include mortality, lapses, expenses, interest rates, and policyholder behavior. A product can appear profitable on average but become unattractive after stress testing guarantees, adverse selection, or lower than expected persistency. Cover premium and benefit projections, expenses, persistency, mortality or morbidity, investment returns, guarantees, capital requirements, present value metrics, sensitivity testing, and the distinction between expected profitability and actual emerging experience. Question 9. Tell me about a time you used data to identify a risk or improve a process. In a coursework project, I noticed that a recurring report contained inconsistent category labels, which distorted trend analysis. I profiled the data, created standardized mapping rules, and reconciled the revised totals to the source records. After documenting the process, I automated the checks and presented the results to my team. The cleaner dataset reduced manual review and made the conclusions more reliable. The experience taught me that data quality is a control issue, not merely a technical inconvenience. Make sure to structure the example with situation, analysis, action, and result. Quantify the impact where possible. Explain data validation, stakeholder communication, and how the improvements strengthened accuracy, efficiency, or risk control. Question 10. What is mortality risk, and how would you analyze it? Mortality risk is the possibility that deaths occur more frequently or earlier than assumed. I would analyze exposure and claims by age, underwriting class, policy duration, product, and distribution channel, then compare actual to expected results. I would consider credibility, selection effects, medical trends, socioeconomic differences, and mortality improvement. The findings could influence pricing, reserves, reinsurance, and capital. I would also distinguish random fluctuation from a persistent change requiring revised assumptions. Discuss the probability and timing of death, mortality tables, underwriting, age and cohort effects, experience studies, credibility, selection, improvement trends, and the financial impact on pricing and reserves. Question 11. How would you analyze lapse or policyholder behavior risk? I would segment lapses by policy duration, product, premium size, channel, geography, and customer characteristics, then compare actual behavior with assumptions. I would investigate economic drivers, affordability, competitive rates, policy design, and interest rate movements. Lapses can reduce expected future profits, create liquidity needs, or produce anti-selection when healthier policyholders leave. I would validate the model on recent experience, stress alternative behaviors, and communicate uncertainty rather than presenting one forecast as certain. Focus on lapse definitions, duration and policy characteristics, economic conditions, premium affordability, interest rate effects, cohort analysis, anti-selection, model validation, and the impact on profitability, liquidity, and reserves. Question 12. What is the time value of money, and why does it matter in insurance? The time value of money means a dollar received today is worth more than a dollar received later because it can be invested. In insurance, liabilities and premiums often extend for decades, so I would discount projected cash flows to compare them on a consistent basis. The selected discount rate materially affects reserves, pricing, and profitability. Longer duration cash flows are more sensitive to rates, which is why valuation and must be considered together. Explain that money available today can earn a return, introduce discounting and present value, connect the concept to long-dated premiums and benefits, and mention interest rate assumptions, duration, and valuation sensitivity. Question 13. How would you evaluate an investment portfolio supporting insurance liabilities? I would begin with the liability profile, including duration, cash flow timing, guarantees, and liquidity needs. Then I would assess portfolio yield, duration matching, credit quality, concentration, diversification, liquidity, and capital implications. Higher yielding assets may improve returns but introduce default, spread, or liquidity risk. I would run interest rate, credit, and surrender stresses and compare outcomes with risk appetite. The right portfolio is not simply the highest yielding one, it is the one that reliably supports obligations. Discuss liability objectives, yield, duration, credit quality, liquidity, diversification, concentration limits, capital charges, stress testing, and the trade-off between return enhancement and protecting policyholder obligations. Question 14. What financial metrics would you monitor for an insurance business? I would monitor premium and sales growth, persistency, mortality or morbidity experience, expense ratios, investment income, operating earnings, reserve development, capital and surplus, liquidity, and risk-adjusted returns. I would separate one-time effects from recurring performance and compare actual results with plan and prior periods. For example, strong premium growth could be unattractive if pricing is weak or capital consumption is excessive. The most useful analysis combines financial metrics with underlying business and risk drivers. Mention premium growth, profitability, operating expenses, investment income, reserve development, capital and surplus, liquidity, persistency, mortality experience, risk-adjusted returns, and why trends matter more than isolated figures. Question 15. Describe a financial model you have built or reviewed. I built a forecasting model that projected monthly cash flows using historical drivers and scenario assumptions. I separated inputs, calculations, and outputs, added data checks, reconciled totals to source information, and tested extreme cases. I also documented the logic so another person could review it efficiently. When presenting the results, I explained which conclusions were robust and which depended heavily on assumptions. That experience reinforced that a good model must be transparent, controlled, and useful for decisions. In your answer, explain the model's purpose, inputs, formulas, controls, assumptions, validation, scenario analysis, documentation, and how you communicated limitations or recommendations to users. Question 16. How would you handle an assumption that actual experience is materially worse than expected? I would first confirm the data, exposure basis, and calculation, then investigate whether the variance reflects random noise, reporting timing, mix changes, or a genuine trend. I would segment the experience and compare it with external or historical evidence. Next, I would quantify impacts on reserves, earnings, capital, and pricing, run sensitivities, and recommend an assumption response. I would escalate material findings promptly and document the rationale rather than adjusting assumptions mechanically. Be sure to mention validating the data, investigating root causes, distinguishing temporary from structural deterioration, updating assumptions appropriately, quantifying financial effects, escalating concerns, and documenting governance and management actions. Question 17. What is capital management in a life insurance company? Capital management ensures the company maintains enough financial resources to absorb adverse outcomes while supporting planned growth. I would consider regulatory requirements, internal risk appetite, product guarantees, asset risks, mortality, lapses, and stress scenarios. Management may use pricing, reinsurance, investment changes, product design, or retained earnings to manage capital. The objective is not simply maximizing capital. It is maintaining confidence and solvency while deploying surplus efficiently for policyholders and the business. Cover capital as a buffer against adverse outcomes, regulatory and internal requirements, risk-based capital, stress testing, dividends or distributions, growth needs, reinsurance, and balancing resilience with efficient use of surplus. Question 18. How do reinsurance arrangements affect an insurer's financial results? Reinsurance transfers some insurance risk to another insurer in exchange for premiums and can reduce volatility, support capacity, or provide capital relief. I would analyze ceded premiums, expected recoveries, commissions, reserve effects, counterparty strength, contract terms, and concentration. Reinsurance is not automatically profitable because the ceded price and collateral requirements matter. I would evaluate the arrangement under normal and stressed claims scenarios and confirm that the intended risk transfer is reflected economically and operationally. Discuss risk transfer, premiums, ceded benefits, commissions, counterparty risk, capital relief, concentration, treaty structure, and the need to assess economics under both expected experience and stressed claims scenarios. Question 19. How would you explain a complex actuarial result to a senior business leader? I would lead with the conclusion and its business implication, then explain the 2 or 3 drivers that matter most. For example, I might say that a lapse assumption change reduces projected profit because fewer policies remain in force, supported by a simple chart and quantified range. I would avoid unnecessary jargon, distinguish observed experience from modeled assumptions, and state limitations clearly. I would finish with recommended actions, such as monitoring, repricing, or further analysis. Focus on starting with the decision and headline, translating technical findings into financial and business consequences, using clear visuals, separating facts from assumptions, addressing uncertainty, and offering practical recommendations. Question 20. What qualities would make you successful in a finance or actuarial role at New York Life? I would bring analytical discipline, attention to detail, and a willingness to challenge assumptions respectfully. I am also comfortable learning technical material, checking my work, and explaining conclusions clearly to different audiences. Insurance requires patience because decisions and liabilities extend over many years, so integrity and consistency matter. At New York Life, I would pair those qualities with a policyholder-focused mindset, collaborate across functions, and keep developing through feedback, experience, and actuarial education. Mention analytical rigor, integrity, curiosity, communication, attention to detail, collaboration, resilience through exams or deadlines, respect for policyholders, and the ability to connect technical work with long-term business outcomes. If you are still with us, congratulations! You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.